Hello guys, this is Prof from Benko Forex Academy speaking. I want to welcome you all to the channel. If this is your first time, I would kindly ask you to hit that red subscribe button so that you subscribe to the channel and support me as well as the channel and everyone else who is going to benefit from these free videos that I'll be sharing here. So today I've decided to talk about the concept of liquidity. This is a smart money concept. It's an ICT concept that is very important for you if you are going to be a successful price action trader. Before I talk about the concept of liquidity, let me just compare retail trading against institutional trading. So the idea of retail trading is not in the amount of money that you're going to be trading. It's not about you trading $100 account. It's not about you trading $1,000 account. It's not about trading $100,000 account either. You can trade a $100,000 account but still be a retail trader. You can trade a $100 account but be an institutional trader. The idea is in the thinking, in the organization of your thoughts. When you look at the price action chart, what do you see? When you are synthesizing and digesting price, what do you see? What do you comprehend? What do you understand? What decisions are you going to take when you're looking at price action? How do you take your trades? That's what then classifies you into a retail trader and an institutional trader. So even if you don't have enough money to trade, if you are a startup trader, don't worry. This information is going to help you and assist you. What you just need to do is to decide the best time frame that you are gonna be trading. Are you going to focus on a minute chart, or are you going to focus on a day one chart? That will be your own decision to make. But the information here applies across. Remember the fractality of price. Price is fractal. What you see on M1 chart is the same price action that you're gonna see on D1 chart or a weekly chart or a monthly chart. So without wasting your time, guys, let's talk about this concept of liquidity. So there are different or various forms of liquidity. We're going to discuss what we call external range liquidity, and then we're also going to talk about internal range liquidity and what we call trend line liquidity. So liquidity basically represents the orders that are here. So what happens is when institutions want to fill in their orders, because they have a lot of money, they won't be able to trade like what retailers do, because remember, where there's a buyer, there has to be a seller. So if they want to sell into this move, they cannot just do it here where everyone else is expecting to be selling. If they do it here, they are not going to be able to fill up all their orders. So what they need to do is they need to take the price higher by being buyers. They know that they want to sell, but they will then put more money into the market and be buyers. If they are buyers here, because if you're going to take your trade here, if you're going to sell here, your stop loss is always going to be above this high. This is what we have been taught by so many, or this is what we practice, or what retail traders practice. This is what almost all the strategies teach you, that when you take your trade here, make sure the stop loss is just maybe 10 pips, 25 pips, depending on the strategy, above this candle here, or above this high here that was set here. So because these issues know that your stop loss is here, where you have put your stop loss here, you're saying, well, if the price continues to buy, I want to be out here. So what they will do is they will make sure that they push the price, and then where your orders are, they will then put their sales there and take the price down. They will then push you out of the market, then they become sellers as you become a buyer by your stop loss. So that's basically what happens. So whenever price is going to be making these pivot points, because someone is intuitively has put their stop loss there. If you are trailing, sometimes you would have protected your profit by putting your stop loss there. Here, if you're a buyer here, you would have put your stop loss there. If you're a buyer there, you would probably maybe you have put your stop loss there. If you're buying there, stop loss there. If you're buying there, if you are a seller in this move, Probably maybe your stop loss is up there, your stop loss is up there. So there are orders all there lying around there. So basically what these institutions are looking at is when they see your stop losses, they are seeing orders. What I need you to know, guys, is you should not view the market as if someone is going after your stop loss, or as if someone is, or the broker is tricking you into putting your stop loss there so that they come and remove it. Remember, when you're putting this stop loss, it's going to be your decision anyway. You are the one who's going to decide where and how to put your stop loss. So it's not like the broker or the institutions are after you, or it's a rat race, it's a fight between you and the institutions or between you and the broker. But basically what you then need to do is you need to understand this concept of liquidity and make sure that you organize your thoughts to be just like the institutions are trading. So what I have marked here on this chart for you is what we call trend line liquidity. So trend line liquidity, because the retail mentality, let me not say retail traders, but the retail mentality here is whenever price touches the trend line, they expect to be buyers. Whenever it touches the trend line on the top, they will be selling. So that's how retail mentality is like. And they also, the other strategies, like the other strategy that I teach on this channel of trading channels and trading patterns. If you look here, this is an ascending channel. And on the third touch, you would be expecting to sell this as a risk entry up there. So already they do know that you have sold there. Well, yes, because of risk management and the other things that comes into trading holistically, you will be managing your trade so that if this happens, you are not going to be caught on the wrong side. You are not going to trade religiously, but you'll be using your mind as well as a business person, trying to make sure that you protect your profits and you minimize your losses, as we teach on this channel. So basically, because all these people are putting their stop losses below these pivot points that are on the trend lines, it then follows that below this pivot point there is a lot of liquidity there. There are orders lying there in such a way that if these guys want to take price higher, they can afford to put the price down there and utilize your orders by getting more buys to the upside and make profit on it. The same applies when we have this pivot point there. Then there are a lot of orders again on top there, because that's where almost everyone's stop loss is. So what they are going to do is they will push the price up there and try to induce you into being a seller. But the moment you sell, they will then take price a little bit higher again, so that they keep on getting those orders before they can have this bigger move that you are seeing here. Of course, we are going to be talking about how you can then manage to see these things happening and taking advantage of these things to get this big trade that you are seeing here. This then comes in as our entry strategies and all that. You can go to our channel and see how you can take advantage of that. So the same is here again. Below this trend line, there is a lot of liquidity because retail mentality is expecting to sell if we break the trend line like that. And your stop loss will be above there. So above there again, there is a lot of money there. Below this again, there is a lot of liquidity there. Below this, there is a lot of liquidity there. If you check here, this is almost equal. So they induced here. And then they just tapped into this order block and started selling again. So we would expect that when they come back this side, when they start selling again, this is not going to hold. So probably maybe they will take liquidity there, and just take liquidity again here, maybe react from this side. This is basically what we call trend line liquidity. And as well, there is what we call internal range liquidity and external range liquidity. If you take this as your range, from here to here. What we call internal range liquidity is all this liquidity that we are seeing here. And what we call external range liquidity is what we're going to find out there, which will be on a higher time frame. So you also need to understand liquidity on smaller time frames and liquidity on a higher time frame. I've put a good example. There's an example on a weekly chart that we'll look at in this video, where we have external range liquidity on a higher time frame, superseding internal range liquidity and external range liquidity on a lower time frame. So let's move on to the next example and continue our discussion. So I've indicated that here this price action chart you are given here is similar to this price action you are given here, but the only difference that is that this now is magnified and this is a bit smaller in size compared to this. If you check how price tapped this low twice, that's the same thing that has happened here before. Price just broke that high and quickly came back above, just like what it did here, that it went up, broke this and quickly came above. Why did it quickly came this side like this? Is because below these two lows, the retail mentality, you would have registered in your mind that because the price is reacting on this support, we would expect it to respond at this support again and start buying. So because of that, there are a lot of people that are going to take buy trades here. It might not be you, because now you understand the concept of liquidity, but believe me, there are a lot of people that are going to try and take their trades exactly here and take their buy trades here based on this support. So is also here, there are a lot of people that are going to take trades based off of support here trying to buy again. And there are also people that are going to try to buy again here, because this order block here that you see here has been, that block structure there has been respected. There are people who are going to do that, but I will teach you the proper way to trade these order blocks. How do you trade the order blocks? So there are also people who are going to try, because retail mentality, since you have seen that price was respecting these supports, there are people who are going to try to utilize this point here to buy because based off of support. That's why you see those two reactions there to induce people to buy, because in their mental reasoning, it has been registered that when price comes to this support, it is always respecting that support and buy before it can come back. But what we know is there is a lot of money below these pivot points, so price is not just going to respect and go up. If it does, that's inducement. What would expect that price to take the orders there first before it can buy, like what it did here, that it had to take the orders back, the orders there before it could then go up again. This is another form of trend line liquidity that we see in this triangle shape. Those who trade patterns understand what I'm saying. And basically what we do know is, because there is a pivot point here, we would expect price to start by taking the orders that are here before we can then go to the upside. And indeed, if you check this candlestick close, it wicked below this pivot point here to make sure that all the orders here have been utilized before price could go to the upside. Above here again, there is a lot of money everywhere. I've put dollar signs. There is a lot of money there that institutions will be looking to utilize if they want to take their trades. So the institutional mentality is for you to make sure that when you are taking your trades, you bear in mind the concept of liquidity there. Before you can sell here, you want to see if the the orders above has been utilized. Before you can think of buying here, you want to make sure that the orders below this point have been utilized as well, because basically what you can see here is, if you have been watching videos on this channel, you would see that this is one wave 2, wave 3, wave 4, wave 5, and a correction. And basically what we would want to, if you check, this is around 61.8 Fibonacci retracement. So basically, before you can trade that 61.8, if that's what you are trading, you would want to make sure that these orders are utilized. Before you can trade the pattern, if this is the pattern that you are trading, in this case, you would want to make sure that that pattern has been utilized. We can't talk of an order block here because there is no order block. Indeed, you can see that the price had already broken structure there. If anything, we would have expected price to come back this side before it can continue buying. Yes, someone would argue that, well, it's a continuation trade because this point has broken, this order block has led to break of this. But look here, after breaking this point, we also have another retracement there that has led to this, and it has been broken by taking this, inducing a sell mode, and it came to retest, and this is the continuation sell. So here, this is not a valid order block. What we call this position is an inducement. This is an inducement. It's just an illusion for people who are trading ICT concept, people who are trading patterns. If you're not careful, this is where you then lose your money, because you're going to take a trade there, then your stop loss will be hit here, helping the institution to enjoy this big move. So basically, this is what we are calling liquidity. Let's move on to the next example there, where I was saying I have prepared gold for you. So this is a chart, a weekly chart on our gold right now. This is how the weekly chart for gold look like. Look, the same price action that we have been seeing on the previous chart is almost the same price action that we are presented with here. Look how price tapped this so-called support in the mind of retail thinking, in the based on retail concepts. Look at how price has been hitting this support line. Well, some are saying, well, this is a weekly chart, here you can make $1 million. Yes, I agree with you, but this is not where where the concept is about. We are talking about the mentality behind. This is a retail mentality. If we then degrade it to lower time frame, because the price is fractal, you wouldn't be able to make money out of this move. It's only now that this is a weekly chart that you can argue, say, well, probably I would have made $1 million. This is like 1, 2, 3, 4. It's enough. It's a month almost. I would be enjoying myself. Yes, I totally agree with you. But this is retail mentality, and with retail mentality, you will never be able to win in the market. It's not sustainable. Relying on indicators is not sustainable. Why? Because these smart man, these institutions, they do know that that's what you have been taught, and that's what you what forms the major part of your strategy. That's what forms the major part of your thinking. And I'm saying, well, let's think like them if we want to trade like them. And understanding the concept of liquidity will help you be in the same wavelength with these guys. Look at how they've been hitting that side. There is a lot of money now on top there. If price should come back to this, I don't expect it to just weak like that, to touch that support line and come down. I would expect price to go up and even continue going up from there, because there is a lot of money up there. And even here on this pivot point there is a lot of money there that they are going to come down and take. You can join my Telegram channel. In that Telegram channel, I'll be posting my analysis on gold. I'm expecting this to be 1, 2, 3, 4, 5, and we have completed 5 waves there. And this is just a retracement to around these areas. This is just 61.8 to the 78 levels there. Fibonacci levels. So to those who are in my Telegram channel and those who join my Telegram channel, I will be posting analysis on gold. But that's not where we are today. Today we are just talking about liquidity. Look how price came here and made sure that they collect all the orders that are below here. And after collecting the orders, what happened? The price started going to the upside. Yes, it reacted off this order block here that we are seeing here, but remember, it reacted here because they had enough orders there to sustain this big move going to the upside. They had to create that retail mentality, support and resistance mentality, here by weakening this support line before they can continue to the upside. So basically, that's what we are talking about today: liquidity. Make sure you take advantage of this liquidity concept in your analysis. Make sure when you're looking at price action, you look for these pivot points. Look for these pivot points because that's where the money is. And don't be caught on the wrong side by institutions, because they can move markets anyway. Markets move because of money. They don't move because of numbers. Retail traders might be a lot of them, but their financial muscle is not enough to push institutions. So institutions are always going to be ruling these markets. So what you basically need to do is you need to think like them, be like them if you want to trade with them. You cannot trade with them if you don't understand these concepts of liquidity and the other concepts that we're teaching on this channel. So basically what you need, what you can see now here is this is the classical triple top that we learn from various strategies. But look here, this triple top is just creating that mentality that if should price come back to this level, I'm selling. But that's not the right thing to see this. When you look at it as there is a lot of money above these highs. And if ever I'm going to sell, I need to see them taking that money first. If they grab that money first, then I can join them along the way. That's how you should be viewing this price action chart. Well, I want to wish you the best, guys, in your trading. If you haven't subscribed yet, please subscribe to the channel. More videos are coming on different concepts. I'll be teaching you my strategy bit by bit. Before I go, I have prepared this one for you. So talking of the reaction here, someone will say, yeah, well, this is 1, 2, 3, 4, 5, 6, 7 weeks. Who is crazy enough to wait for 7 weeks to take this buy trade that you are seeing here? Well, I tell you, even if you have $100 account, this is easy to wait for this. Let me show you on the lower time frame how this will be looking like. Let's go to the lower time frames. I've prepared this for you. Let's go to the lower time frames and see how it looks like. This is the D1 time frame that we have here. This is the D1 time frame that we have here. So basically, if you check here on the D1, when the price took liquidity here, and continued going to the downside on week 1 time frame, it then created an order block there, which was respected when price was going to the upside. If you trade demand, supply and demand, you're going to see that this candlestick was a bearish candlestick, which then came back to take off this. So even below this this week of a candlestick on lower time frame, this is an order block that we can look at. It's a demand zone, a valid demand zone that we can look at. And what happened? Price went on to break structure. This is D1, ladies and gentlemen. Price went up to break structure there, as I've indicated. After breaking the structure, then it started coming to the downside. So you would have waited, just observed. Because remember, guys, we are making money here. This business is about making money. Patience. You need patience when it comes to trading. If you're not patient, you're always going to be donating your money. You need to wait for trades to mature, guys. You need to develop that mentality of being a proper sniper. A sniper waits. You need to have patience, guys. So you would have been patiently waiting for price to come back way to this order block. But this is D1. You might not be having enough money to wait for this to happen on D1. Let's go to H4. Look at what happened on H4 there, as I have marked there. Look, this was trendline liquidity, isn't it? The concept that we have been talking about. And this is the break of structure that I've indicated on D1 that I was telling you about. Then price came back in a trending mode again. This creating trendline liquidity again. You would have taken your trade off this H4 order block here, or here, or the same, the stop loss would be below this red line that I've indicated here to say, well, that's where you put your stop loss. You would have taken your trade there and your trade there and just wait for it to materialize. Where is your take profit? Your take profit is just above this previous high. You don't need to be too ambitious in the market. The markets are always moving. Just grab what you came for and go. So this would be your take profit position, ladies and gentlemen. So this is what you'll be expecting to get from the market. So this is what I have for you guys. I wish you all the best. I hope you're going to improve in your trading by watching these videos, by learning these concepts every day. Never grow tired of learning. Learning will pay off. Make sure you understand this concept and make sure you improve your trading. Thank you very much. You have a blessed trading